Please subscribe to the channel, and let's listen about the approaching disaster.
Remains in power. So that's him winning the war, because in the beginning of that, it was worth his cost. I mean, he wants more than that. He wants a neutral Ukraine or an aligned Ukraine, but he's not going to probably go get that. But that's the minimum. Now, that's him winning the war. That's also kind of the West losing the war. But if he loses the war, if he loses that, he will probably escalate, okay? Because the war is now being played as a on-the-ground, armies to armies, and with sanctions. But he has other weapons. And rather than go down, he will probably escalate. That's a game of chicken. It's a very dangerous game. And there are other issues globally. For example, you're seeing these alliances work out, and the United States, for various reasons, sort of pull out of the Middle East, and you're seeing China more move in. And so these tensions exist and power exists. There are more countries that have nuclear weapons now than there were. You know, there's even talk of joint military operations between China and Iran. And so you see these sides begin to align. So if I say that there's a 1 in 3 chance of some kind of a military confrontation, that scares the hell out of us, over that is extremely, I don't think that sounds too high. I think it's larger than that. So that means I think we're headed for some risky times, because any one of those things is not normal. It's pretty bad. If everybody worries, they don't have to worry. If both sides think about what that's like and say, we must come together and make sure that that does not happen. The best assets to not own, that's the most important, I think, is cash. I'm quoted, cash is trash. There will be a tightening here for the time being, and that tightening will have an effect. It'll hurt asset prices and so on, but cash is not the asset to own, and bonds are not good to own, in my opinion, because it's debt. It's owning somebody's debt. And you won't get a return. Think of it, the interest rate will not reach the inflation rate. So that's the problem. Then what you have to have, I think most importantly, is a well-diversified portfolio of other assets. Diversification is a very powerful tool because it can reduce risks without reducing expected returns. Now, there's lots of ways of getting what you think good investments are. They might be things you know about, local businesses and so on, or they might be stocks, or they could be maybe a little gold, or maybe a little bit foreign investing. Diversification is very important to do that in a balanced way. So I would generally say that would be what I would recommend. This was 1982, 83. I had to borrow $4,000 from my dad to help to take care of my family bills. So I remember thinking, how many weeks could I live if I lost my income? And I started counting in weeks. I think that's the way to do it. And then assume that its buying power over the next number of years can fall by 3 or 4% a year. Or if you put it in a risky investment, like stocks or something, it can fall by more. So cut that number maybe in half and have twice as much, because you have to understand that that's your freedom. That is your safety. So that first band, you must take care of that. Once you get past that and you feel, okay, I could take care of my family in a worst case scenario, then you have the freedom to then take other kinds of risks. But when you're building that portfolio, it's the same thing as when you have a lot of portfolio past that, just you want to diversify well, because you could see what happens to the markets. Every market, stock market, bond market, most markets have had times where they've gone down over an extended period 60 or 70% in buying power. One thing I do for my kids and grandkids, and always did, was for every holiday, like Christmas or their birthday, I would give them a gold coin. And I said, I never want you to sell that gold coin until there's an emergency, a real emergency, never because you want to buy things. And the reason I did that, and they'll build over a period of time, and I said, don't even sell it, you pass it to your kids, unless there's an emergency. And so you're building that savings. Because I think we so easily spend so much money on junk. I didn't like debt because of the fact that there's an obligation, and it's like, oh, if I get, then I'm going to be drowning. I'm trying to keep my head against water. This is just my own bias. But anyway, the truth is, if you find individual bets that are diversifying, that your return will equal the average of those returns, but your risk can be cut by 80%. By a bet, I mean, like if you say, I'm going to invest in the stock market, you can see whatever the bet is, look back in history, it gives you a pretty good idea of how it goes up and down, what your risks are. Do that by looking at it in inflation adjusted terms is the best way, but it goes up and down and you can see how your buying power is. If the worst case happened, what would that look like? And I'm telling you, like I'm saying, that the worst cases when you look at that is something like 60 or 70% in buying power, whether that's stocks or bonds. However, if you do that with uncorrelated investments, like when commodities go up, bonds go down, that kind of thing, and you balance things, then you find some part goes up when the other part goes down. And by doing that, you can reduce the risk without reducing the return. Holy Grail means if you follow this path, this will be the key to your riches. 10 to 15 good uncorrelated return streams. I always have to think about what's the worst case scenario. Can I handle the worst case scenario, whatever that is? You can be a great investor, you can be great at anything, and it'll only be one time that knocks you out. One time will kill you. It's often the case that I believe I can produce a significantly higher return, I have, than the cost that I pay for debt. So it's a logical thing to do it, and I still don't do it much. And there's one thing about debt for consumption and debt for investment. Debt for consumption is really bad because the asset goes away and you're left with this obligation. And that's risky and it's stressful, piles up. You're living above your means. Don't do that. It's not a good idea. Whereas if you have debt for investment, you better be pretty sure that the returns on that investment will be higher than you have to give back in money in the form of both interest rates and the principal repayments. The best investments are typically those things that you're closest to, and they fall into two types. Those that affect your living standards, like I think owning a house or an apartment or your residence affects your life a lot. And the cost of it is not the cost of it. In other words, you buy it at a certain price. It's not like the thing that goes away and you consume, so you'll sell it at a certain price. And probably you'll modify it over a period of time. You'll make things, and it produces kind of a forced savings that also brings you joy and brings you a better environment, generally speaking. And then the other thing is things that you might know really, really well. Is it your own little business? But you could still take the cycle. So those are the two things that I think debt are good for. I should say that one thing when I did that, I discovered the three forces that I mentioned. I discovered a fourth and a fifth that are very important and big. One is that, interestingly, acts of nature in the form of droughts, floods, and pandemics have had a bigger impact than the things I've been talking about in terms of cost more lives or toppled more civilizations, those acts of nature. So I think that's something probably that we have to be concerned about. But number 5, over long periods of time, 10, 15, 20, 30 years, the most powerful force is man's ability to adapt and invent. Here's a Great Depression and here's a war. And as you see those things, they look like blips on the chart of life expectancy, per capita income, and so on. So there's a tremendous capacity for dealing with all the other stuff if man can adapt to it well. And inventiveness during this period of time should be kind of, I think, really great, because what we're using more and more is types of technology, artificial intelligence and so on. The ability to think and collect data and use the computer to help us with that is a very, very powerful force. Now, like any forces, it's also a risky force because it can be used for bad as well as for good. I think the world will evolve. We will have these cycles in the world. So that's what you see. You see these cycles and then you see evolution through those cycles and adaptation. And so I expect that. But I would say there's the probabilities I gave you before, that concern me. A lot will be unknown. We have a lot of potential and a lot of things to worry about. I think we're in an era of that money as we know it, which is a fiat money, is being devalued and it's going to change. The dollar's role is going to change, and that alternatives are going to compete with that. So I wouldn't want to own money when you own a dollar, let's say, is in the form of a debt instrument. So you're going to get paid back in that. And I think it'll have a negative real rate, negative buying power, and so on in almost any currency. And they're all competing. So they're all devaluing, essentially. And so money is both a medium of exchange and a storehold of wealth that is portable and works in most countries. And now we'll find out what those things are. I mean, gold is an example of one of those, and crypto is an example of those. Maybe NFTs are, and who knows? I think we're in a kind of a who knows kind of phase. New things come along, and I think they'll compete. People will start to think about, how do I have a portfolio of those things that are widely accepted, that I can and that maintain buying power? There's challenges to that. Like when you have a lot of volatility in it, it means that, oh my God, my owning it is more risky than my not owning it. And so that drives money into sort of other things. But anyway, we're going to struggle with that, and you're going to see digital currencies in different countries and so on. And I honestly don't know. I don't think one thing wins out. I do think that a lot of the crypto, like all markets, they go through phases. And there's kind of the bubble phase where it goes up a lot and everybody believes it and everybody's bought it. And then you have the adjustments and so on. I think there's too much emphasis in it because the total value, of Bitcoin or even the cryptocurrency is comparable to the value of Microsoft. One has to think, when one thinks of assets, I would rather think of the whole array of assets than to think about, is it going to be that crypto Bitcoin one?
Yes.
I think people can be too concentrated on that. And I think that can be dangerous. Diversification is my key. Let me start off by saying I acquired it by an accident because the game that I happened to fall in love with, if you learn to play the game well, it pays well. Well, I think that's true with a lot of people who are coming up with ideas and building businesses and so on. They got excited about it, it works well, and then it pays well. To me, it's a serious mistake thinking that success is measured in such things because money has no intrinsic value. Okay, what does money get you and what do you need? Now, what I want is freedom and the ability to be creative and do that's what I want. And money helps me get that. It helps me help other people. It helps me have the impact. I like those things about it. I think that success is having the life that you want to have, as long as you're earning more money than you spend. And that can be spending very little and having a wonderfully luxurious life. I watch a lot of people don't have much money of different ages, sometimes young, sometimes older. They travel around the world, they backpack, they go to different cultures and different places. They can live in a tent and the most beautiful nature is available to you, or you can be in a hostel, or you can meet in so many different, and freedom and so on. I think everybody should almost experience that to know that they can have a great deal of freedom without a great deal of money. And that status thing is a silly thing. Okay, that's like being hung up on living your life for approvals. And so don't get on the track and lose sight that, okay, what is it that you really want in your life? What is a successful life for you? It's not measured by how much money you have or how much status you have or almost that other stuff. It's measured in, like I would say, meaningful work and meaningful relationships. If you have something as your work that you're into and your craft and it's a thing you love and you have meaningful relationships, I think those are the most important things to make a rich life.
During this period, wealth disparities decrease, and collaborative efforts are made to construct a thriving society. However, as prosperity expands, so does inequality, resulting in widening wealth gaps over time. The affluent, possessing the means, can afford superior opportunities for their children, perpetuating this disparity.